Hello and welcome to another episode of the Federal Church Presents Better Than Bloomberg. Coverage of the 2023 global financial markets collapse. The global financial system collapse. The markets will soon follow. There's a market wrap from Zero Hedge for March 20th, 2023. Bitcoin, Bullion, and bond yield. That's U.S. market. Higher as credit market rejects bank bailout bullishness. We'll play on words there for bullshit. That's exactly what I was talking about too, where the talking heads like to talk about things that are completely irrelevant. Yeah, Credit Suisse being bailed out, that means some stability in the system, blah blah. Well, yeah, sure. Doesn't change the facts that all your banks are insolvent because they went the wrong way on the dipshit trade. Your banks are still insolvent. It has nothing to do with the Swiss bank. Or whatever other crap that they were spewing with God knows what. While First Republic, I guess that's the new media darling there. While First Republic was tanking to its lowest share prices ever because it's insolvent. Like many other banks. But another weekend, another few, and again, that was PPT Monday, by the way. Levitating things from the dead. Printing money, adding fuel to the fire, making everybody pour through inflation. But another weekend, another few tens of billions of dollars, euros, or more thrown at the wall. And the result was a lot of headline sound and fury and, yeah, the bullshit, resilience and safe and no exposure. But little shift in trading positions. As repo guru Scott Skirm, Executive Vice President at Curvature Securities, noted, just 3 weeks ago I sent my annual Ides of March commentary, and guess what? The Ides of March struck again. Now that a second crisis hit the market, I wonder if this is the beginning of a larger crisis or the end of a small crisis. This is but just the beginning of a larger crisis. Now, you have several hundred banks that are insolvent, and nobody in their right minds will be keeping their money in these banks. And when these banks go under, which they will, because they shouldn't be operating because they were managed by dipshits, then you have the big banks go under too. Again, this is not a causality, but in time. Big banks go under too because the derivatives that they wrote or their counterparty do blow up. And yes, it'll be a tremendous crisis. And there's nothing really that they can do to fix it because if they print more money, they just add fuel to the inflation fire. If you recall, the financial crisis really began in 2007 and they never recovered. They just printed money trying to paper over it. And now the day of reckoning has come. The second leg was the collapse of Bear Stearns in March, April 2008. Final leg was the collapse of Lehman in September 2000. Again, these banks will collapse much sooner than that. There's several hundred of them that they found already. They'll find more. And yeah, they'll just keep on collapsing as the days go on. And just like I said, the first few banks, maybe they'll get bailouts, but over time, that's when they go into bail-ins, where they get to learn about fractional reserve banking and haircuts and bank holidays. It's a holiday. We believe the next financial crisis could follow a similar pattern. Then here is some question. Was SVB the Bear Stearns and Credit Suisse the Lehman? No. And no. Because Bear had problems with some derivatives that were only traded by a few people, making the liquidity of it pretty bad too, by the way. And so did Lehman. SVB was a simple depository institution run by dipshits. One of them even worked for the Fed. And they couldn't even handle that. A simple depository institution. This isn't an investment bank. This isn't an investment bank with a trading side that engages in speculative trading or acts as a prime broker, and then, sells basically other banks, hedging products, so to speak. This was just a simple depository institution run by dipshits who could not foresee that rates would be rising after printing trillions of dollars. Because they're dipshits. Credit Suisse is an investment bank. It had a lot of good businesses until it had problems with affirmative action. And then there are many other problems with the banks over the years, or many problems over the years in addition, or in, simultaneously with that. Because of that, actually. And it eventually had to be sold because of some other shenanigans too. It eventually had to be sold because, well, ultimately they probably went the wrong way on the dipshit trade too. So no, it's not like Lehman. They didn't screw up on some, exotic derivative product. It was the dipshit trade. And again, there's no contagion there in the sense of Bear Stearns and Lehman. Not yet, at least. I mean, it will when the derivatives blow up. But, or like you see with the what they did with, there's also another way where it's being affected with how the regulators are dealing with it, like with Credit Suisse and the tranche, what was it, the AT1 tranche that was supposed to be superior to the shareholders, but still got hosed while the shareholders got bailed out. So, that sort of thing will definitely now affect derivatives. Or are SVB and Credit Suisse the first round, like the liquidity crisis of 2007, and there's a larger crisis on the horizon? No, it's not just the first round. They're just the first few banks to go. And like I said, the first few ones will probably be bailed out. But over time, as the number of banks reaches the hundreds, you're going to probably go to the bail-in that they were supposed to be doing from the beginning. And this is not a liquidity crisis. This is an insolvency crisis. Because they all did the dipshit trade. US and EU financial stocks ended the day marginally higher, not exactly reassuring that the problem is fixed. And again, the bailout of Credit Suisse does not change the fact that all these banks are insolvent. Then as UBS absorbed this toxic bank, UBS's CDS widened to 11-year highs and was put on watch negative by S&P Global Rating, while the stock rebounded from an ugly 16% plunge at the open. Which again, you get this volatility on the way down to zero because you got the hopium, and of course you got the intervention, or they'll be printing money, adding fuel to the fire, trying to prop these things up, but ultimately it fails because the banks are insolvent. The broader European financial system credit risk barely budged on the weekend's news. And across the pond in America, First Republic shares crashed 48% to a new record low, which is because it's insolvent and it's the next bank to go under. Despite last week's $30 billion inflow bailout, which doesn't change the fact that it's insolvent. Could be worse. You could have been a CSAT1 bondholder who thought you were above equity in the capital structure. Which again, when the regulators do shenanigans like that, well, now your derivatives have problems. Those bonds went full Kaiser Soze. The broad U.S. equity markets rallied on the day, though NASDAQ lagged and was basically unchanged. Relief rally on Sunday futures open, selling through the Asia session. Again, I wouldn't call it a rally. I'd call it the hopium. and just the volatility from intervention, PPT, printing money, but the intervention always fails. Europe saw, again, on the way down to zero. And mentioned that volatility before, just like you saw in 2008. Europe saw a bid into the U.S. cash open when NASDAQ went sideways while the rest of the majors drifted higher. U.S. regional bank stocks barely managed gains on the day, which they shouldn't because they're going under, which is probably more intervention because it should be going to zero. Office REITs were hoping for a big update but ended after plunging for 8 straight days. Squeeze was ignited at the cash open, but it faded fast with most shorter stocks ending lower on the day. Again, hopium and little PPT intervention. Just adding volatility on the way down to zero. Treasury yields closed higher across the curve today, but only after a wild roller coaster overnight with the short end underperforming. Note the violent panic bid in the U.S. Treasuries as Asia closed, and the non-stop selling through the European and U.S. sessions. Wonder why. 2-year yields tagged 4%, puked down to near 3.6% before exploding all the way back up to 4%, an 80 basis point swing intraday. Now that is a wild ride for a day at the short end. Liquidity is non-existent. There you go. And that's when liquidity matters. When the supposed risk-free bonds, or I guess the business bills, whatever, bills. When the risk-free, when the risk-free toiletries are not liquid, in what's supposed to be the most liquid, one of the most liquid debt markets on earth, now you're having problems. Goldman Trader answers the number one investor question of the week. Why did you have to excuse me, the money changer still tampering with my food. Telling people to tamper with my food. The number one investor question of the week. Why did the S&P hold in so well this week? And then it's quad witching, where about 3 trillion. The index options expire. Set to unclench the gamma. Major Reverend part of risk present. That's more of a market plumbing issue. But also, because these banks are insolvent. Inflation expectation swaps have tumbled in the last week or two. Again, they're selling on that crap to the Fed. Inflation expectation swaps have tumbled in the last week or two since SVB and CS spoiled the party. Dollar dumped to 1-month lows. And it'll dump much more than that over time. Bitcoin hit a 9-month high intraday, above 28,000. Gold topped 2,000 intraday, but couldn't hold it. Precious metal still. Prices followed a similar path to everything else, diving overnight, then ramping higher during the European U.S. sessions to close green. Interestingly, gold surged up to a key level relative to oil today. 1 ounce of gold can buy 30 barrels of oil. Level only is reached in crisis moments. Finally, Goldman warns that market implied recession risk for the next 12 months and picked up above 50%. Fed pricing being a core driver. Historically, this drove more equity drawdown risk, especially if risky assets were reflecting little recession risk. Currently, they only imply a 30% probability of being in a recession. In light of that, we note that the Fed rate hike expectations rose notably today. They're slipping lower overnight, as you might expect given the banking system fragility. Probabilities then reversed as Europe opened for no clear reason, ending higher on the day with expectations for a hike this week rising. Hawkish and terminal rate also rising. Meaning again, those banks get even more insolvent. And that debt crap they can only sell to the Fed. The market is now pricing a 70% chance of 25 basis points from the Fed this week. Former New York Fed President Bill Dudley proclaimed. The case for zero is do no harm. We know the banking system is under stress, so why would you continue to raise rates when the banking system is under stress? Is the market thinking that the Fed thinks it's solved the financial crisis, so time to refocus on the inflation issue? Do not from the above chart that the terminal rate now in May is just 30 basis points above the current levels, 4.875%. After that, almost 100 basis points of rate cuts are priced in by year end. Translation: a huge capitulation by the Fed, big recession, and or global financial crisis escalates. Well, doesn't matter what the Fed does. It's writing checks it can't cash. So it can't bail out all those banks and all those deposits and all those trillions of dollars and still claim raising rates and quantitative tightening. Yes, the global financial crisis is escalating. It was just as you saw as the hopium went on. Another bank in the U.S. decided to implode, or was imploding. Share prices nosediving. And there will be many other banks to follow. And as the implosions go on. Oh, and I think the new bank in they're focusing on in the media there is Deutsche Bank. Which again is a bank that has already been in trouble, but due to the dipshit trade, likely is in even more trouble. But yeah, especially in the United States, you will see more banks fail because they did the dipshit trade. And it will be a global financial crisis because there will be others who did the dipshit trade. And it is not a contagion in the sense of Lehman or Bear. It's the fact that all of them did it because it was done by convention. And now they're all screwed. All because you did not pay your tithe. God is very angry at you. So you need to pay your tithe. Make the donation into the Bitcoin wallet there in the description. And maybe, probably not here on Earth, probably not in this lifetime, but when you're in heaven, it will pay dividends and dividends. Donate.